Hello everyone, welcome back to InvestIQ Network. Today, we're diving into the world of dividend investing and how you can build a passive income stream. Whether you're a beginner or a seasoned investor, this guide will provide valuable insights to help you on your investment journey. Dividend investing is a powerful strategy that allows you to earn income regularly from your investments, and if done correctly, it can lead to financial independence. So, let's get started. First, let's understand how dividends work. Dividends are payments made by a corporation to its shareholders, usually in the form of cash or additional stock. They are typically distributed from a company's profits. By investing in dividend-paying stocks, you can earn a steady income stream, regardless of stock price fluctuations. For example, if you own 100 shares of a company that pays an annual dividend of $2 per share, you would receive $200 in dividends each year. This is in addition to any potential gains from the increase in the stock's price. There are different types of dividends you might encounter. Regular cash dividends. These are the most common type of dividends and are paid out on a set schedule, usually quarterly. Companies that are stable and well-established, such as utility companies or consumer goods companies, are often known for paying regular dividends. Suppose you own 100 shares of a company that pays a quarterly dividend of 50 cents per share. For times a year, you will receive $50, totaling $200 annually. These payments are consistently predictable and provide a stable source of income. Special dividends. These are one-time payments often resulting from extraordinary profits or surplus cash that a company wants to distribute to its shareholders. These dividends are not recurring and are often considered as bonuses. If a company sells a subsidiary or receives a windfall profit, it might decide to distribute a portion of these earnings to shareholders in the form of a special dividend. For instance, if you own 100 shares and the company decides to pay a special dividend of $1 per share, you will receive $100 one time. Stock dividends. Instead of paying dividends in cash, some companies choose to distribute dividends in the form of additional shares. This means shareholders receive more shares rather than cash. If a company pays a 5% stock dividend and you own 100 shares, you will receive 5 additional shares, bringing your total to 105 shares. These extra shares can increase the value of your investment over time as you own a larger portion of the company. Finding high-yield dividend stocks is crucial for maximizing your income. Look for companies with a strong track record of dividend payments, stable earnings, and a sustainable payout ratio. The payout ratio is the percentage of earnings paid out as dividends. A payout ratio that's too high might indicate that the company is not reinvesting enough in its own growth. For example, if a company earns $1 per share and pays out 50 cents in dividends, it has a payout ratio of 50%. This is generally considered healthy. However, a payout ratio over 80% might be a red flag unless the company has very stable earnings. Some industries are known for their reliable dividends, such as utilities, consumer staples, and healthcare. These sectors tend to be less volatile and have companies with stable cash flows, making them ideal for dividend investors. When evaluating dividend stocks, consider the dividend yield, which is the annual dividend payment divided by the stock price. For instance, if a stock pays $2 per year in dividends and its current price is $40, the dividend yield is 5%. This can be an attractive yield, but always consider the sustainability of the dividend. Diversification is key to managing risk in your dividend portfolio. Aim to include a mix of sectors and industries to spread out your risk and increase potential returns. A well-diversified portfolio can weather market volatility better than one concentrated in a single sector. For instance, you might include utility companies, known for their steady dividends, technology firms, with strong growth potential. Consumer staples, for stability. Each sector has its own characteristics and risk profile, so diversifying helps protect your portfolio from sector-specific downturns. Consider also geographic diversification. Investing in international dividend stocks can provide exposure to different markets and economies, further reducing risk. For example, you might invest in European or Asian dividend-paying stocks, which can offer different growth opportunities and economic conditions compared to North American companies. Exchange-traded funds, ETFs, focused on dividends can also be a great way to diversify without picking individual stocks. ETFs pool together a collection of dividend-paying stocks, providing instant diversification and often lower risk. Look for ETFs that focus on high dividend yields or those that include a mix of domestic and international stocks. Reinvesting your dividends can significantly boost your portfolio's growth over time. Many brokerage accounts offer automatic dividend reinvestment plans, also known as DRIPs. By reinvesting, you're using your dividends to purchase more shares, compounding your returns. For example, let's say you have $10,000 invested in a stock with a 4% annual dividend yield. This means you earn $400 in dividends each year. If you reinvest these dividends to buy more shares, the number of shares you own increases, and each new share will generate its own dividends. Over time, this compounding effect can lead to substantial growth. Imagine reinvesting your dividends every year for 20 years. The difference between reinvesting and not reinvesting can be thousands or even tens of thousands of dollars. This strategy helps you maximize the potential of your investments. The power of compounding is remarkable. Here's a more detailed example. If you start with $10,000 invested in a stock with a 4% annual dividend yield and reinvest those dividends, after 20 years, you could have around $22,000. Without reinvesting, you'd have only $18,000. This extra growth comes from the reinvested dividends generating their own returns, creating a snowball effect. Let's look at some case studies of successful dividend investors. These real-life examples can provide inspiration and strategies that you can apply to your own investments. Warren Buffett is one of the most famous dividend investors. Through his company, Berkshire Hathaway, Buffett has invested in numerous dividend-paying stocks such as Coca-Cola and American Express. His strategy focuses on buying quality companies at a fair price and holding them long-term, allowing the power of dividends to compound. Buffett's investment in Coca-Cola is a prime example. He purchased shares in 1988, and since then, the dividends paid by Coca-Cola have increased significantly. Initially, he invested around $1 billion, and today, the annual dividends from Coca-Cola alone are over $600 million. Another example is John D. Rockefeller, who famously said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Rockefeller built a substantial fortune through strategic investments in dividend-paying companies. He believed in the power of reinvesting dividends to grow his wealth over time. These investors share a common approach: patience, discipline, and a focus on long-term growth. They reinvest their dividends and allow their investments to grow over time, demonstrating the power of dividend investing. To wrap things up, remember that dividend investing is a long-term strategy that requires patience and discipline. Stay informed, keep an eye on your portfolio, and continue to reinvest your dividends. By doing so, you can build a substantial passive income stream over time. Here are some final tips to ensure success with dividend investing. Regularly review your portfolio. Even the best companies can face challenges. Regularly review your holdings to ensure they still meet your investment criteria. Stay informed, keep up with market news and trends. Understanding the economic environment can help you make better investment decisions. Be patient, dividend investing is not a get-rich-quick scheme. It takes time for the compounding effect to show significant results. Diversify, as mentioned earlier. Diversification is key to managing risk. Don't put all your money into one or two stocks. If you found this video helpful, don't forget to like, share, and subscribe for more investment tips. And if you have any questions or topics you'd like us to cover in future videos, leave a comment below. Thanks for watching, and happy investing!